Great. Well, good morning, everyone. Thank you for joining us here, and thank you, Liz, for that great macroeconomic backdrop. What I'd like to do with this panel, this wonderful panel I have with me here today, is delve now into the detail in terms of what this actually means, this macroeconomic environment for credit committees, and how capital is actually being allocated in hospitality and hotels today. So I have a wonderful panel here. We've got Ilinka Kayana from Erste Bank Group, Chief Risk Officer. We've got Tim Lord, who's Head of Climate and Energy at HSBC. And we've got Saidam Salahuddin, Global Head of Real Estate Lending at Deutsche Bank Group. So thank you for being with me here today. So Tim, I'd love to start with you to kind of give a bit of the climate and energy context here. Where are we on climate and energy transition in the UK, and what does it mean for UK real estate?
Sure, so big question, and I've been working on climate, energy, sustainability for about 20 years. I'm sure many people in the room have as well, and you're kind of contractually obligated to start by saying it's a very complex and fast-moving space, right? But I think that is actually particularly true at the moment and over the last 12 months, and Liz has touched on some of the macro reasons for that. But I do think we're in a kind of different phase of this agenda from a global perspective, from a UK perspective, and from a real estate and hospitality perspective as well. So if I start with the global picture, and if we sort of zoom out a long way, I think we've kind of had three phases of this agenda, right? We had the kind of CSR phase where it was important, but for governments and for corporates, it was slightly the thing you did when you'd done all the things that were your core role, right? Slightly sat on the side of the business. And that lasted for a pretty long time. We then had the last 5 years or so, sort of 2018 to 23, 24, which was the kind of target setting phase. And then all the big governments, all the big corporates turn up and say, right, we're going to set net zero targets. This is core to our strategy. Sustainability, absolutely front and center for the business. And now we're in a phase where the world's more complicated because we have to focus on how do we implement, how do we deliver all that stuff? What does it actually mean? My background is working in government for most of my career, from working with ministers. It's very clear that setting targets is a lot easier than achieving targets, whether it's inflation or net zero or anything else. So what's now emerging globally, I think, is a kind of multi-speed transition. Obviously, we've touched on what's happening in the US, moving in a different direction, China doubling down on this transition, Europe doubling down on this transition, investment rising globally overall, so up over 2 trillion in energy investment in 2024 and 2025, and also a real shift in terms of electrification, driven mainly by China, but also other countries moving quickly as well. So a really complex picture globally. If we think about the UK, so the UK's done a great job in decarbonisation, right? And the ministers I used to work for always start with the stat that the UK's led the world in decarbonisation. It's more than halved emissions since 1990, while it's grown the economy by over 80%. But we've actually done that in a relatively straightforward way. Most of that transition's been done in the power sector. So we've closed down our coal-fired power stations and we built lots of renewables. And that's great, but there's only so many coal-fired power stations you can close down, right? And we've closed all of them now in the UK. So the next phase looks very different, partly because it's a net zero transition. When I worked in government, I led the team that set the net zero target. And what I found, the UK before that had an 80% emission reduction target. And when we set the net zero target, what we found was that everyone thought they were in the 20% that was too hard to decarbonise, right? So you've got to do, and we find that in our businesses too when we set these targets, I think. So it has to be a multi-sectoral transition. The power sector is going to continue to be really important, but it is about buildings, agriculture, transport, heating, and so on. But also fundamentally, it's a very investment-heavy transition. So investment in this space needs to double, not out to 2050, but in the next 5 years from where it's been over the last 5 years. And that, again, a huge challenge given some of the headwinds that Liz just touched on. And what we're seeing with this government is they are doubling down on this transition. They were elected to do that. It's core to their economic strategy, in particular in the power sector. But more broadly, it is hard to get the economic incentives right to enable it. And then if I touch finally on the real estate sector in particular, I mean, the real estate sector in some ways is a microcosm of the challenge, because when we look at emissions over the last 10 years or so, emissions from this sector have been pretty flat. Now, there have been lots of improvements, so we've got more buildings and they're more efficient than they were, but the net effect is that emissions haven't changed very much. If we look ahead, we need to roughly halve them over the next decade. We need to reduce them by about 75% by 2040 and then to zero by 2050. So that is just a qualitatively different challenge. And I think it's a particular challenge in this sector because of the nature of the buildings that we use. Some new, of course, and there's some challenges there as have been touched on already, but lots of retrofit, often in old, quite complex buildings in challenging environments, in particular because this sector faces a lot of customer pressure in lots of different directions around cost and around sustainability. And also because this sector is right on the hard edge of one of the biggest challenges for the UK economy, which is our energy prices. So on the one hand, fundamental to this transition for this sector is electrification. On the other hand, we've got some of the highest electricity prices in the world. So a really, really big challenge, I think, in terms of that changing environment. I think in some ways a propitious policy environment in the UK and a lot of change needed in this sector, but really challenging to make it happen.
Very interesting. Thank you, Tim. And second question, how does a lender fit into this? And what motivates HSBC in this space in terms of motivating your clients to invest in energy efficiency?
Yeah, sure. So I think in terms of our role as a lender, first of all, it's a significant role, partly because of our scale and the fact that we operate globally and the dependence that this sector has on us to help it make the investments that are needed. I guess the first thing I'd say is that fundamentally we need to be customer-led. And I think part of that sort of target setting phase that I talked about over the last few years was there was a slight sense that you can do this stuff top-down. You can't do it top-down. It has to be driven by clients. What do our clients want to do and where do they want to invest? So we need to move with them. What we do find, and we did a survey very recently around this, is that actually our corporate clients, perhaps slightly contrary to some of the media headlines that you might see, are really leaning into this transition. So 90% plus of them see it as a growth opportunity. And when we look at this sector, the proportion of companies that are looking to allocate more than 10% of their capital to the net zero and the energy transition is set to double over the next couple of years. So we do see a kind of client base which really wants to lean into this agenda and sees it as important. But having said that, sees it as really challenging because, as I say, setting targets easy, figuring out how to meet them, what it means for an individual business, an individual building, is much, much more difficult. So in terms of our role, I think we'd see it in a few ways. First of all, it's about being a strategic partner for our clients. So we've done a lot of work with clients around their transition plans, what that looks like and what it means for investment. I think secondly, it's about providing them with the tools for that. So we've got things like building sustainability assessment tools. And I think earlier in the day already, we've touched on some of the data challenges around this, which are enormous. So helping clients to navigate that. I think thirdly, it's about tailored financial products to get the incentives right. Where we see clients investing, it's because the commercials make sense for them. And obviously the way that we finance those investments can obviously really support them in doing that. And then fourth, I think really importantly, it's about how do we connect up across our client base. So we've got HSBC Innovation Banking, that's the market leader in the innovation and tech space here in the UK. What we need to do more of is connecting the clients, and I think you'll hear from some of these types of companies later, the clients who've got really innovative solutions to some of these challenges with the companies who need to install them and make them operable in their businesses, in their buildings, and so on. So I think if we can do all of those things, then what we ultimately hopefully can do is to help make the commercials make sense for our clients to make these investments, because trying to figure out how, when to do that, how to price it, how to manage that in what is quite a complex space in terms of opportunity cost and the different things they might do is really important. The last thing I will say is that we're figuring this out as well, right? So we've got a net zero transition plan. We're going through the same as a global bank, the same set of data challenges, the same set of questions about how and when to invest. So listening to clients is hugely important to us to learn what they need.
Thank you. That's very interesting. And I apologize. I don't think I've given my background when I introduced everyone. So I work for Kingdom Hotel Investments. So we are a big real estate and operating company investor in hospitality and luxury hotels. And I would add that this is also something that is a top priority of us within our hotels that we own, to remain very relevant, to stay ahead of the curve, to avoid potentially going in the direction of a stranded asset. But it's also a lot of pride that we have from our customers' standpoint. They look for this. This is something that is very important nowadays. And it's a challenge to navigate that landscape and to make sure that it also makes financial sense to continue investing in that space. So I would argue, and I have some team members here in one of our hotels from Paris, that we are very happy to be continuing, to make strides in that direction. But it's a challenging landscape to navigate, absolutely. So it's good to hear your perspective on that. Now I'd like to turn more to the capital allocation and sort of the underwriting environment. I think, Saidam, this is a perfect segue to you here. Hospitality has become a larger part from the commercial real estate investment side. So Why has it grown, and what is your perspective on this?
Let me say a few things about that. My personal journey with DB is now 7.5 years. In that time, when I arrived, I think our hotel hospitality business was a few percent and a handful of hotels. It really was nothing. And today, it is our largest single asset category. Almost a third of the book of the commercial real estate hospitality, and that's now approaching 65 hotels around the world, from LA to Hong Kong and Singapore. So, is that just my business? I'd be interested to hear what other lenders think. Maybe we just suddenly picked up and started to do better in the hospitality sector. But I think there must be underlying growth. We heard the stats, the 2.5 billion extra people. We heard a lot of our own experience. I think if I ask many people in this world, my kids, your friends, our partners, our colleagues, people are spending more and more time in experiential living, more than they would have as a percentage of their disposable income in the past. And I saw something very interesting a couple of days ago saying Gen Z is the first generation that actually borrows to spend on experience ahead of buying a property. So rather than buying your first house, you will go and borrow £10,000 to go around the world and climb Kilimanjaro or whatever else you're going to do. And hospitality has really, and I'd love to hear what Kingdom thinks, hospitality for me has been such a fantastically interesting journey in this last 10 years because it's mushrooming into all different shapes and sizes, right? We all know trends towards wellness. We all know trends towards different types of hotels, whether they're mountain, whether they're safari, whether they're on the beach, whether they're in the city, whether they are boutique party hotels or whether they are capsule hotels. The type of hotel and hospitality that we see is really diversifying extremely rapidly. And that's a journey that, as you said, Tim, we're learning as we go along. We're traveling with that journey, and we're traveling with our clients who are creating that product. There's a lot more, we heard the stats, there's a lot more product to be created, particularly in LATAM, in the Middle East, in Africa. Money is flowing into the sector. People are retrofitting, refurbishing old offices which are no longer of use in that particular location into different forms of living, particularly hospitality. And all those factors converging mean that this is a really fascinating, growing, but also growing, not just growing in size, but growing in its diversity and in its, probably you can hear in my voice, the passion that I have for it is growing too, because it's fascinating to see that. So yeah, look, and I'm a private banking lender. I lend to individuals who own assets. Some of those are very big as institutions. We see that trend towards hospitality and more different types of hospitality, and we're lending to it. And we'll come back to the sustainability aspects of that a bit later, I'm sure.
No, it's a very good point. And again, from our standpoint, we invest in real estate, but we also invest in these operating companies. Four Seasons is one of those big investments that we have. And the trend is absolutely in this direction, the experiential hospitality horizontally we're launching the yacht in a month, for example, which is a very new venture for us within Four Seasons. We've got our big residential push now in residential hospitality. And this experiential travel is just becoming very big. We're moving away from these big box 200 key hotels to more boutique experiential 40, 50 room hotels that often from a business standpoint need to make sense, especially within that luxury level of service. But when we start building these country portfolios in certain locations, it can make a lot of sense from a shared services standpoint. Customers look forward to traveling to a destination, potentially, do a little ski trip and then stop into Florence, and then so it's a very interesting landscape and it's constantly evolving. So it resonates very much with me, what you just mentioned. So Ilinka.
Yes.
As Chief Risk Officer at Erste Bank, what is your perspective on the hospitality landscape and the volatility in the markets, and how do you assess this risk?
As I was listening to all the speakers before saying how unpredictable and uncertain our environment is, I was thinking about my job, which is very much, standardized, and we have clear rules how to underwrite the hospitality and real estate in general. And maybe the regulation is something which gives us in Europe really this possibility to keep the things tidy and continue on doing good job in keeping the high standards and really creating a good future for all our assets. So in underwriting, we have very clear standards, what we can underwrite, which kind of soft facts or other hard facts we need from the hospitality segment in order to give them also better price and also to be able to manage the risks. If we don't get these data, then we have also to create like kind of stress testing sensitivities of the portfolio and really account for this in our pricings. Mm-hmm. So there is a variety of different possibilities how to manage really the risks of our portfolio, especially the hospitality, which is very volatile, and we saw it in COVID. We see it nowadays in the climate change, which is here. If we want it or not, we see every day. And as you were mentioning, Austria is where we are based. Is a country where skiing is a big topic. The small hotels, family hotels. And it is very difficult for them if they don't develop into and if they don't transform their businesses according to the climate change, they will not survive. And this is why us banks are trying to put all these components together and put them into underwriting standards and give them the prices that they can live with, that they can earn, and really transform throughout the time. So, yeah.
Thank you. And this is a great segue, actually, in terms of what differentiates a deal that receives conviction versus where it can be more challenging from a lender standpoint. So I'd like to segue back to you, Saidam, in terms of your model seems to be very client first, less asset first. Maybe you can walk me through a bit how that changes the underwriting logic.
Sure. I don't think it necessarily changes it, but there's a slightly different emphasis. So as a private bank, we lend to, again, individuals more than institutions, despite the size of some of those individuals, being extremely large. But and they like to own assets. They like to own assets of different types and different sizes and different locations and different ages. Right? You can't compare a Claridge's with a Shard if you're talking about new hotels versus old hotels, and they bring very different questions when you're underwriting those assets. So we do start with the same sort of analysis that my colleagues here at HSBC and Esther would do on an asset basis. It's about the quality of the asset, the location, the track record, the management, the execution, as I heard a few times this morning. Execution is everything in hospitality. And that's very important to us. But it's very different if you're lending to one of those Austrian families who have had that single hotel in their family business for 100 years, or if you're lending to somebody worth tens of billions that has operations all across the world and a very different kind of financial profile. We obviously take that account as private banking lenders. So we will lend, I'm not just saying more or more aggressively, but typically we would take into account the net wealth and the liquidity of a sponsor, perhaps more than a traditional high street lender would, where it's just all about the asset. For us, it's about relationship. Relationships are like assets. Assets are very long-standing, or hopefully they will be long-standing. Relationships, we hope to be long-standing. So we want to be the last to ever have to enforce our security, and therefore our underwriting takes into account very, very carefully who the sponsor is and how we can do things in a way that will never put us into that position. Otherwise, what's the point of being a private bank? Mm-hmm.
And Ilinka, back to you. In terms of what increases lender confidence, from a governance and reporting standpoint? Maybe you can delve a little bit more into the detail there.
Usually when you lend somebody the money, it is very important you are not underwriting only the asset, you are underwriting actually the governance. So how the certain lender is really dealing with controls, internal controls, how they are driving their business, what kind of data they can provide you in order to really have a proof that they are developing well. So basically the answer is very simple. The more you trust your customers, the better you can deal with them, and the better their internal processes are, the better they offer us also the data they have. The more they cooperate with us, it is much easier for us also to lend them money and keep them on track also.
Do you build these reporting requirements into the loan agreements early on, or is this something you build over time in terms of?
Well, at the beginning, usually they know what we are expecting from them, but over the time, this is also progressing. So as their businesses are developing, we are also asking them for more data in order to serve them better. So there is on one side our obligation toward the regulator to do a good reports also on ESG and all the other requirements. But on the other side, it helps us also really to understand our customers and serve them better if they share it with us.
Well, it's a great segue back to ESG, actually. It's materially affecting pricing and access to capital these days. And my question now is, it's a general question, is it still largely compliance driven, or is there something more to it? And I think I'd like to shift this back to you, Tim, actually, in terms of, we hear a lot about this, and you spoke very nicely about this transition, but what does that actually mean for HSBC in terms of your engagement with clients, and how much of it does it factor in credit decisions, the ESG component?
Sure, so I think it's a really important factor and an increasingly important factor in terms of our engagement with clients. So, when we look at our largest clients globally, we've gone through detailed transition plans with about 4,000 of those, but with smaller clients, mid-sized businesses, and smaller than that here in the UK, for example, we've also gone through quite detailed kind of transition engagement to understand and help us understand, and hopefully help them understand, what does the transition mean for them in the short, medium, and long term. And I guess the two big changes that we've seen over the last few years is first of all, that point I made earlier around practicality. So you're not having quite so many general conversations about sustainability or ESG. You're talking about specific investments, specific plans. And often, as we move into the next phase of the transition, it is about quite large investments in heating systems in buildings or in deep retrofit, et cetera, which are challenging decisions for businesses and indeed for lenders to make. The other big change I think we see is that it's much more embedded in broader conversations. So you're not sort of wheeling out the sustainability team to have a conversation about sustainability, which is separate from your kind of wider engagement with the client. It's much more deeply embedded in that, I think, hopefully from our side, but certainly from the client side as well. I think in terms of credit decisions and so on, obviously there's a pretty wide range of factors that we take into account in credit decisions. I mean, the key thing I think from our side is making sure that clients have an understanding around what the transition means to them. In some cases, if they are looking at, say, for example, investments in things like renewables or batteries, it's really understanding the return on those investments. And that's evolving incredibly quickly, right? 5 years ago, we were having no conversations about solar battery systems, for example, in buildings. But now, when you look at the way that the economics of that have shifted, in some cases, they're, 50% cheaper than they were even a couple of years ago. The question then for us and for that business is, will they be 50% cheaper again in a couple of years? And that again creates some complexity. But I think the other thing is really thinking about and understanding climate risk and transition risk. We all know that consumers in this space are demanding. They're demanding from a sustainability perspective. They're also demanding from a comfort and a cost perspective as well. So how we balance all of that, but also the physical risk challenges that many buildings, in all parts of the world, including here in the UK, face. Making sure that those are really deeply and well understood, and we can factor those into our decision processes as well.
And back to you, Alinka, in terms of the the risk frameworks. I mean, how integrated are these decarbonization targets built into your frameworks?
Oh, they're very much integrated. So we are also committed to the decarbonization and have clear goals for 2030 and 2050, so to be at net zero. And this is also implemented in the whole risk management framework. So in Pillar 2, in internal capital adequacy assessments, we are having early warnings if we basically drift off from the decarbonization plans, then it would immediately pop up, and we would take care and take a look why it's not moving as it's supposed to move. And this also gives us permanently the possibility also to talk to our lenders and explain them how this is important. I would also like to mention that there is also a community with Österreichische Kontrollbank, so, which is basically collecting from the different companies in whole Austria the data, and we are paying for these services in order that it happens. So they are basically filling into ESG templates, and the banks are able to basically use them for their decarbonization processes and also in order to better serve and also advise the customers how to move forward and how to implement the transformation processes in their businesses.
Thank you.
So,
back to you, Saidam. In private markets, does sustainability-linked pricing really move the needle in a meaningful way?
Good question. Probably not enough, I would say. I think, well, let me just say a few things to echo what I'll segue into that from what Alinka was just saying. 10 years ago, as a lender, I very rarely ever heard the word BREEAM, LEED, EPC. You know, we didn't even ask the questions. I think as terrible to say that, but I must admit it. We didn't even ask the questions. It's very important that this is pushed top down from regulation, from government, and from policy, because I think that sets a course of direction, and it focuses the mind for people like us, for the banks, for the lenders. And when we are then now, as you say, Alinka, incorporating these into our standard, not just wheeling out, as Tim said, not here's a sustainability person to talk to you. You know, when it's front and center on our underwriting guidelines, and one of the first things we have to ask and think about and document, it makes us do it. And therefore it makes us ask the right questions of the client and encourage them to do the right things or to think about the right things or to warn them of what will happen if they don't make investments into their asset of a certain type by a certain period. So that's pushed down, top down. But the importance of that is it comes down to us and then it filters back out into the individual client base. And I think we're all on that journey. So yeah, it's an admission of fault of our industry. We are also being pushed by regulators daily, as I'm sure you two are, to why aren't we doing more? How are we doing more? How are we going to do more? We heard in the morning it's not just about the BREEAM or the EPC certificate anymore. Embodied carbon, you know, wastewater, noise pollution, light pollution. It's becoming complicated, and it's becoming harder and harder to measure, as we heard. So we, as lenders, in our responsible role of pushing society and people to do the right thing and allocate capital in the right way, need to give more incentives on pricing, to answer your question. I can tell you internally, we do have a treasury benefit given to us for green assets. We call it the greenium, and we can allocate that to deals and to clients where we think they are doing the right thing, or, importantly, to encourage them to do the right thing. So to retrofit rather than destroy the building and rebuild it, to go in and do the technical work on the systems. You know, again, 10 years ago, we didn't really get into the nitty-gritty of the technical systems. Now we're asking, why are you spending this much on that? And why shouldn't you spend a bit more to get this benefit? And the client typically says, it costs me more money. Haven't got the money to do that. You know, it's a commercial investment decision for them. So we try to soften that by giving them a bit of a better pricing. That has not yet filtered through to the regulators in terms of how our capital treatment is given to us. And I think the very first session this morning, having the IFRS and the standard setters recognize that capital allocation should be different, or capital treatment should be different for better rated assets and better rated behavior is super important, because I want that to come down to us so that we can have cheaper capital for that purpose, and then I can allocate that cheaper capital, and it becomes then the sort of, what was this, the cycle that you mentioned earlier, the affirming cycle or the rewarding cycle. And that's what we're trying to do, but I don't think it's anywhere near what it needs to be to really influence large-scale change of behavior.
Thank you. Final question, and this is to all of you, so whoever wants to take this one, but what would you say is one risk that hospitality owners may be underestimating in this higher cost of capital environment? Whoever wants to go first.
I'm yet to meet a hospitality owner that underestimates any risk. I think the nature of hospitality, and again, we've heard it a few times this morning, it's a 24/7. It's one of which is what makes it so fascinating, but difficult and challenging. It lives and breathes all day and night long, and it doesn't take breaks for weekends or holidays. So I can see a few hotel owners that I know in the audience, and they are constantly thinking day and night about, and trying to solve problems that have come up. So not sure, but I think look, we're definitely, and we've heard it, this is not a cycle. The post-COVID dividend or boom in hospitality, after us all being locked down for a while, is not just a cyclical thing. It's structural, right? We've heard about the numbers, the population, the demographics, the rising middle class, and people want to spend more on experiences. So hospitality is here to stay, and it's going to keep developing. So I don't think people are worried about the demand for hospitality. I think it's how do you adapt in this very changing world, and how do you stay relevant? I think staying relevant is becoming, you're an investor in Four Seasons. Four Seasons is a wonderful brand, has been so for a long time, but I can imagine the challenges of a great brand is keeping up with the times and keeping up with these changing needs of the new generations coming through the ranks.
And using artificial intelligence properly, right? Because it's all about service.
Great point.
But using that information that we have in the correct way to enhance that experience, I think, is going to be the challenge, because the competition is going to catch up with us. Now they all have a lot of data, and they can work that information, right? So fully agree. I think that would be one of the risks I see, is staying ahead of that curve and using the information we have wisely. Anyone else want to add to that? I don't know how much time we have left. Yeah, because we could also move to some questions from the audience.
We have some questions.
Happy to comment briefly. I think I completely agree with that. This sector is one that is pretty mature in the way that it thinks about risk, because it's often been on the hard end of some big pivots in terms of government policy or consumer demand and so on and so forth. The one thing that I think we all need to think more about, and that absolutely includes the banks, is when we think about sustainability risk, climate risk, or adaptation risk, all those kind of things. I think we've got pretty good at thinking about first-order physical risks of flooding and overheating and those kinds of things. I think what we're less good at collectively is thinking about second-order risks as we think about, for example, the impacts on supply chains of extreme heat events elsewhere in the world. And we're increasingly seeing clients being exposed to climate risks, which are sort of 2, 3, 4 steps away in their supply chains, for example. And I think the more maturity that we have around that, in terms of banks and finance providers, but also in terms of businesses operating in this sector, I think the more we can be kind of protected against those second, third order risks, which I think can be really significant in the longer term.
We have a few interesting questions here. Maybe we can hop into one of those energy-related ones. Do EPC A ratings impact banks' cost of capital? If so, by how much?
No, that's the point. That's the point.
Yeah.
So they should, and I'm sure they will. And we all know a stick is coming to the banks in terms of penalising us for, let's say, if you don't have an A. I'm not sure it's a reward, but I think penalties will come eventually to banks for not having the right percentage of green assets in the portfolio, for sure.
So I was laughing when I saw APC A rating, because I think it's very difficult to get it according to the regulations. And especially in the cities like London, Vienna, etc., to move it and to transform it to that level, it's like almost impossible. What we are doing in our bank is we are trying to get better pricing for any kind of efforts in ESG over ratings. So this goes, if you have a good rating, it goes over ratings into the rating of the client, which is then reflected in a cost of capital, lower cost of capital for the clients. So yes, we are trying to do our best, but the regulatory world is very difficult to get the best ratings out of it, or according to the regulation.
This is interesting. I'm not clear what impact sustainability issues are having on your investment decisions.
Where is this one?
Look, I'm not an investor, but we obviously lend to people making investments. I think you're either one of those people that really, most people in the room here, I would assume, because you're here today, care and are on that side of the debate. And I think, how much of your life do you put into put your money where your mouth is? I don't know. That's a good question for each of us to look in the mirror and say, do I take the 50p cheaper option, because it's, or 50p more expensive option because it's better for the world? I don't know. I think my owners of assets are either in the firmly green camp or they're not. Some don't care about it whatsoever, but an increasing proportion of people do. And I see, to give us all hope for the planet, I see some people spending too much on it. Too much in the sense that I don't think there's an economic return. Now, is there ever too much to save the planet? No, but there are certain investments which I've seen clients make, which will not pay back. Will not pay back for decades, and I'm not sure they are commercially the right calculation. But I take my hat off to them, and it's good to see people really aiming for the top, irrespective of the fact that they won't make the necessary return for it. But I think that's a small minority of people, and most will be on the other side of that equation.
There's one interesting here. I think this might be going for you, Tim. How do we break this cycle? Lenders continue to insist on top-down policy and legislation in order to drive action. The government will always shy away from interventionist politics given economic market risks. Interesting.
Yeah, I mean, I think that's a great question. I think the way we break that cycle is through the commercials, as you talked about. So, kind of top-down requirements for on-site renewables or whatever are one thing. If they make financial sense, if the payback periods for those things and the return on investment is kind of within the sort of window that businesses are able to think about, banks are able to lend on, I think fundamentally that is how you get through and break that cycle. And and across a lot of sectors we are seeing that now, right? When you look at the power sector, for example, I was working on that 10 or 15 years ago. The argument essentially was, globally, build lots of renewables because it's the right thing to do, but it won't make economic sense, right? Now you're seeing solar deploying very quickly in Texas, for example, much more quickly than it is anywhere else in the US. And the reason for that is not an ESG reason. The reason for that is because it's the cheapest way to run their power system. And I think those kinds of examples, EVs are another one increasingly, those kinds of examples where policy helps to drive the commercials and the economics. That enables banks to lend, that enables deployment to happen at scale, that brings the cost down further. I think that is how you get there. Having said that, there are, of course, some areas which are always more challenging. It's easy to talk about the solar in Texas example. That is not true of every single element of the transition, right? So the more technologies, the more approaches that we can get into that space where they do make commercial sense for businesses and for lenders ultimately, the quicker we'll see the transition move.
Mm-hmm. And just to add really quickly, and I think organisations like this, I think events like this, I think courses at King's that we talked about, is what's needed, because we all sit in our little boxes. I don't talk to the regulator. I talk to the regulators, but I don't talk to them that often. I don't talk to IFRS. I don't talk to the rest of the ecosystem that I see in this room today. And I think hearing the other perspective and being able to talk to people and figure out how we do it together is probably what we don't do, because we're all too busy sitting in our day job, looking at the screen and answering our boss and our client. And it's too easy to get stuck in that and not collaborate with the others to make things happen.
Great.
Brilliant.
Well, I think we're out of time. Thank you, all of you.
Thank you.
This was a great
Thank you,
session.
Harry.
Thank you very much. Thank you.
That was terrific, guys. Thank you. One thing occurred to me whilst Dan and Maximilian, I think, are coming up next, was this convening power that I think you all have as banks, as insurers, as lenders. I think it's a really interesting point, and it's convening power that, A, you can connect people, Tim, as you were saying, to solution providers, whether it's building management systems or whatever it may be, but you can also help different groups of people get together. In other words, if flood risk is an issue, as it is here in the UK, there's no point, there's limited point in you building your own little walls higher. You're much better off probably working with your neighbours to protect the particular piece of ocean front or whatever it may be. So I think the convening power of the financial organisations is a really interesting idea, and I think they're going to do more of it. Why? Because it's in their own interest. It mitigates the insurance risk, or it protects the margin for the banks. Okay? And I completely agree with the end point. I think we all do. In a way, forget the regulation. In a way. The markets will take care of this. Ultimately, they will. And the politicians will, in the end, follow the markets. So that's gradually what I think is emerging.